and welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Absolutely. It's great to be here.
So let's dive right in. Have you heard about opportunity zones? They're creating quite a buzz, especially with the tax advantages coming up in 2026.
Yeah, they really are, Sarah. It's a fascinating concept that can offer some significant benefits for real estate investors, especially those looking to build wealth over time.
Exactly. And today, we're going to break down what opportunity zones are, how they work, and why they might be a game changer for your investment strategy.
We'll also cover some practical tips on how to identify the right opportunities and the kind of properties that might be most beneficial to invest in.
Plus, we'll touch on some potential pitfalls to avoid so you can navigate this landscape with confidence.
That's right. It's all about making informed decisions and positioning yourself for long-term success.
So whether you're just starting out or you're looking to expand your portfolio, this episode is packed with valuable insights.
Let's get into it. What's the first thing we should know about opportunity zones? So, Sarah, when we think about opportunity zones and why they're so relevant right now, especially for folks over 40, it really ties back to how retirement timelines are shifting, right?
Exactly, Mike. A lot of people are starting to think about their financial futures more seriously as they approach retirement age. With rising inflation, they're looking for ways to protect their wealth.
Right, and opportunity zones can be a powerful tool here. It's not just about tax advantages, but also about how they can help shield investments from the volatility we're seeing in the market.
Yeah, I mean, let's face it, the stock market has been all over the place lately. People want something stable, something tangible. Real estate offers that, especially in these designated zones.
Absolutely, and I've seen clients who, they used to just rely on traditional stocks and bonds, but now they're looking more at real estate as a way to diversify their portfolios.
And with the potential for capital gains tax deferral, it's like a double win. They can invest in these areas, see potential growth, and not have that immediate tax burden hanging over them.
Exactly. Just to give you an example, I worked with a couple in their early 50s who had some savings but were worried about outliving their money. They wanted to retire in 10 years, but were getting anxious about how inflation was eating into their savings.
That's a real concern. So what did they do?
Well, they ended up investing in an opportunity zone property that not only provided them with rental income, but also had significant appreciation potential. They were able to defer taxes on the gains from their previous investments, which gave them a lot more financial breathing room.
That's really smart. It's like they turned a potential worry into a strategic advantage.
Exactly. And that's a key point for listeners today. The emotional security that comes from having a solid investment can't be overstated, especially when you're thinking about wealth transfer to family.
Right. You want to leave a legacy, not just savings that might dwindle away. Real estate, especially in these zones, can provide a lasting asset that appreciates over time.
And it's not just about the numbers, it's about peace of mind. Knowing that you have a tangible asset that's working for you can really reduce stress as you head into retirement.
And I think a lot of people overlook that emotional side of investing. It's not just about the financial returns, but how it makes you feel about your future.
Exactly. And as we see market shifts, especially with the current economic climate, it's important to have a strategy that can adapt. Opportunity zones are designed to encourage investment in underdeveloped areas, which means there's potential for growth as those areas improve.
And that's another thing. Investing in communities can be rewarding, right? You're not just building wealth for yourself, but also helping to uplift neighborhoods.
Spot on. I've seen investors who, really take pride in knowing their investments are making a difference. They're contributing to local economies while also securing their own financial future.
It's a win-win situation. Plus, with the deadline for some of these tax benefits coming up in 2026, people really need to start thinking about this now.
Yes, the clock is ticking. Waiting too long could mean missing out on some significant tax advantages.
And those advantages can really compound over time. I mean, if you're investing now, you're giving yourself more time to benefit from those tax deferrals and potentially larger returns.
Definitely. I remember another investor I worked with. She was in her late 40s and had been hesitant about making big moves. But once she understood the opportunity zone benefits, she jumped in.
What did she end up doing?
She invested in a mixed-use development in a growing area. Now, not only is she seeing rental income, but the property value has significantly increased. She's already thinking about how to leverage that for future investments.
That's incredible. It's amazing how one decision can change the trajectory of your financial future.
It really is, and for those over 40, it's crucial to make proactive decisions. Time is of the essence when it comes to building wealth.
And with the current trends in the economy, having a real estate investment can be a hedge against inflation too.
Absolutely. Real estate tends to hold its value better during economic downturns compared to other investment options like stocks.
That's a comforting thought. So for someone listening who's maybe on the fence about diving into opportunity zones, what would you say to them?
I'd say, look at your long-term goals. Think about what you want your financial future to look like and how you want to provide for your family. Opportunity zones could be a key part of that plan.
And it's not just about the financial aspect. It's about creating a secure environment for yourself and your loved ones.
Exactly. It's about building a foundation that can weather storms and provide comfort as you move into retirement.
Well, I think this really sets the stage for diving into some core strategies, doesn't it?
It sure does. Let's explore how to approach investing in opportunity zones effectively. So let's dive into some core strategies and rules of thumb that can really help when looking at opportunity zones, especially as we gear up for those tax advantages in 2026.
Absolutely. I think a good starting point is understanding the basics of evaluating deals. What's your go-to rule of thumb for assessing a property?
Well, one of the classic ones is the 1% rule. Basically, you want to aim for the property to generate monthly rent that's at least 1% of the purchase price. So if you buy a property for $200,000, you'd want to see it rent for about $2,000 a month.
Right, that makes sense. It gives you a quick gauge of whether the property could be cash flow positive. But, of course, there are other factors to consider too, right?
Exactly. The 1% rule is a great starting point, but you should also look at the 50% rule when estimating your expenses. This rule suggests that about 50% of your rental income will go towards operating expenses. So, using our earlier example, if you're bringing in $2,000 a month, you'd want to budget about $1,000 for expenses.
Got it. That really helps clarify the cash flow picture. So if you're left with $1,000 after expenses, that's your potential profit before taxes and mortgage payments, right?
Yes, and don't forget about your mortgage payments. You'll need to factor those in too. But that's why understanding cash flow is critical. You want to ensure that you're not just breaking even.
What about cap rates? How do they fit into this?
Good question. The cap rate is another essential metric. It's calculated by dividing the net operating income by the property's purchase price. So if your property generates, say, $24,000 a year in net income from that $200,000 property, your cap rate would be 12%.
Wow, that's a solid cap rate. So typically, what's considered a good cap rate in today's market?
Generally, anything above 8% is seen as a good return, but it really depends on the market. Higher cap rates often indicate higher risk, while lower rates suggest stability.
That makes sense. It's all about balancing risk and return. Now, when we talk about opportunity zones specifically, are there particular property types or markets that are more favorable?
Yes, definitely. Look for properties in areas that are experiencing growth or revitalization. These are typically neighborhoods where there's new investment, like infrastructure improvements or new businesses opening up.
So it's not just about the properties themselves, but also the surrounding community's potential, right?
Exactly. For instance, if you find a property in an opportunity zone that's near a new tech hub or university, that's a positive indicator. Those types of developments often lead to increased demand for housing.
And what about financing options? Are there specific things to consider for investing in opportunity zones?
Absolutely. Traditional financing methods apply, but it's important to know that some lenders may offer special programs for opportunity zone investments. You might also consider using a qualified opportunity fund, which allows you to defer and potentially reduce taxes on capital gains.
Interesting. So if someone sells an asset and invests that capital gain into a qualified opportunity fund, they can really maximize their tax benefits?
Right. By doing that, they can defer taxes on the initial gain until 2026, and if they hold the investment for at least 10 years, any gains from the opportunity zone investment itself are tax-free. It's a pretty appealing strategy.
Wow, that's a big incentive. But I imagine there are still risks involved, right?
You're spot on. It's essential to do your due diligence. You want to evaluate the local market trends, the economic indicators, and the property condition thoroughly.
And having a checklist could help with that, I assume?
Absolutely. A simple checklist could include things like, what's the property's location? What are the local amenities? How's the current rental market? And don't forget to check the zoning regulations.
Those are great points. I think having a structured approach can really help reduce anxiety when making investment decisions.
Definitely. And remember, it's also about building a team you trust, like real estate agents, property managers, and even contractors, because they can provide valuable insights and support.
So it's not just about crunching the numbers. It's about having the right people around you too.
Exactly. And while we're on the topic of pitfalls, one common mistake is underestimating the timeline for returns. Many investors think they'll see quick profits, but real estate is often a long game.
That's a crucial point. It can take time to see the benefits of your investment, especially in opportunity zones where the full tax advantages might not kick in for a few years.
Right. That's why it's essential to have a solid plan and to be prepared for the long haul.
And what about market fluctuations? How should investors be prepared for those?
You should always have a contingency plan. It could be as simple as having some cash reserves set aside to cover unexpected expenses or longer vacancy periods.
So it's really about being proactive rather than reactive.
Exactly. Think ahead and don't let short-term fluctuations throw you off your strategy.
Sounds like a balanced approach is key here.
Absolutely. Balancing your expectations, doing your homework, and being prepared can go a long way in real estate investing, especially in opportunity zones.
That's a lot of valuable info, Mike. I think we've really covered some solid strategies and rules of thumb that can guide our listeners.
For sure. And as we move on, we can discuss some common pitfalls that investors might face in this space. So let's dive into some of those common pitfalls investors face, especially when it comes to opportunity zones. You know, one of the biggest mistakes I see is over-leveraging.
Absolutely. It's so tempting, right? You see the potential returns and think, if I just borrow a bit more, I'll make a killing. But that can backfire quickly.
Exactly. I had a client a few years back who got really excited about a property in an opportunity zone. They secured a hefty loan, thinking they would flip it in 6 months. The market shifted, and they were left holding the bag, paying the mortgage while waiting for the right buyer.
Oh no, that sounds tough. What happened to them in the end?
They ended up in a tough spot. The cash flow wasn't there to cover the loan, and they had to sell at a loss. It taught them a valuable lesson about balancing leverage with the ability to hold onto a property longer than planned.
Right. It's so important to have that buffer. Speaking of cash flow, let's talk about bad tenants.
Yes. Bad tenants can really drain your resources. I had another investor friend who got a little too eager to fill a vacant unit. They rented it out to someone who seemed great on paper, but it turned out they had some serious issues.
Like what?
Well, this tenant was late on rent every month, and then they started causing damage to the property. It was a nightmare. You know, they didn't really vet them properly, and it cost my friend a lot more than just lost rent.
That's a huge one. So how can investors avoid that kind of situation?
It really comes down to thorough screening, checking references, credit history, and previous rental behavior. You want to ask the right questions and trust your gut. If something feels off, it probably is.
So true. And what about ignoring cash flow? That's another big mistake, isn't it?
Absolutely. I've seen investors get so caught up in the potential appreciation of a property that they overlook the cash flow aspect.
Right. Like thinking, oh, this neighborhood is going to boom, but then they forget that they still need to pay the bills every month.
Exactly. I had a colleague who invested in a property in a rapidly developing area. They were convinced rents would skyrocket, but they didn't account for the higher expenses that came with the property.
So what did they do?
They got into a cash crunch. It was a real wake-up call for them. They had to scramble to find a way to raise cash, or worse, consider selling at an inopportune time.
That's a tough lesson. It really highlights the importance of having a solid financial plan, doesn't it?
Definitely. And then there's the issue of timing the market, thinking you can time when to buy and sell perfectly.
That's a tricky game, for sure.
Yeah, I had another investor who was convinced that the market would dip, so they held off buying for what felt like ages. Meanwhile, properties in the area shot up in value.
Oh man.
When they finally decided to jump in, they ended up paying a premium. They kept saying, "I'll just wait for the next dip," but it never came.
That's such a common mindset. So what's the lesson there?
The key is to focus on the long-term investment strategy rather than trying to chase the market. If you find a good property, buy it. Don't wait for that perfect moment that may never come.
Absolutely. And hidden costs. That's another danger zone for investors, right?
Oh, for sure. Many people underestimate those costs. I had a client who bought a property thinking they got a great deal, but they didn't factor in all the maintenance and renovation costs.
What kind of hidden costs are we talking about?
Well, things like property taxes, insurance, and unexpected repairs can really add up. This client had to replace the roof shortly after purchasing, which wiped out their initial profit margin.
Yikes! So what can investors do to spot those hidden costs early?
A thorough inspection is vital. Always get a professional to check for potential issues before you buy. And do your homework on local taxes and insurance rates. It's all part of your due diligence.
That makes so much sense. So, if someone realizes they've made one of these mistakes, what should they do next?
First off, don't panic. Mistakes happen to everyone in this game. Take a step back and assess the situation. If it's a cash flow issue, you might need to adjust your strategy, like increasing rent or cutting unnecessary expenses.
And if it's a tenant issue, maybe consider an eviction if it's warranted.
Exactly. But always follow the laws and regulations in your area. It can be a lengthy process, but it's important to handle it properly.
And for those who are feeling stuck with their investments, what's the best way to recover?
Look for ways to refinance if you're over-leveraged. This could help lower your payments and provide some breathing room. And always keep an eye on your local market trends for opportunities to sell or trade up.
That's great advice. So, in summary, it's all about doing your homework, staying aware of cash flow, and being strategic about your investments.
Exactly. Learn from the mistakes, adjust your strategies, and keep moving forward. There's always a path to recovery in real estate if you're willing to put in the work.
Well said, Mike. I think that wraps up our discussion on common pitfalls.
All right, so let's dive into some actionable steps that you can take right now if you're feeling inspired by the idea of opportunity zones.
Yeah, definitely. It's really about finding practical ways to get started, right?
Exactly. So first off, if you haven't already, I recommend checking out the IRS's official guidelines on opportunity zones. It's a bit dense, but it'll give you a clearer understanding of how the tax benefits work.
That makes sense. And what about tools? Are there any apps or websites you'd suggest for research?
Oh, for sure. Zillow is always a great place to start. You can look up properties in designated opportunity zones, and it has a lot of useful data like home values and rental rates.
Right, and I think another great tool is the Bigger Pockets Calculator. It's super handy for analyzing potential investment properties and figuring out your cash flow.
Absolutely, and if you're looking to rent, Rentometer can help you quickly assess rental prices in a specific area. It's a quick way to see if a property is priced right for the market.
Those are solid suggestions. What about local resources?
Well, accessing your local multiple listing service, or MLS, can be invaluable. It gives you insight into what's available in your target area, plus historical price data.
That's a good point. It's like having a pulse on the market.
Exactly. And if you're not already, consider joining a local real estate investment group or meetup. Networking with other investors can provide insights, support, and even partnership opportunities.
Yeah, I love that idea. It's so important to learn from others who have been in the game longer than you.
Right? Plus, you can discuss deals and share experiences. And speaking of sharing experiences, there are some great books and podcasts out there.
Oh, definitely. What are some of your favorites?
I really like the book on rental property investing by Brandon Turner. He breaks things down in a really relatable way, especially for newer investors.
That's a great one. I'd also recommend the Bigger Pockets podcast. They have a ton of episodes that cover various aspects of real estate, including opportunity zones.
Yes, and don't forget about Rich Dad, Poor Dad by Robert Kiyosaki. It's a classic that really shifts your mindset about money and investing.
Those are all fantastic resources. So let's talk about habits. What are some small steps someone can take every week to keep moving forward?
A simple habit to start with is to analyze at least one potential deal a week. It doesn't have to be a huge commitment, but it keeps you in the loop and helps you practice your analysis skills.
I love that. It's like building a muscle, right? The more you analyze, the better you get at spotting good opportunities.
Exactly. And you could also set a goal to read one chapter of a real estate book every week.
That's manageable. And what about following relevant news or trends?
Yes, subscribing to a real estate newsletter or following real estate blogs can keep you informed about market changes and new laws, especially around opportunity zones.
And you can do that while you're having your morning coffee, right?
Totally. It's all about making small adjustments to your routine.
So what if someone is feeling a bit overwhelmed by all this information?
Well, start where you are. Even if you just spend 15 minutes a day doing research or connecting with someone in the field, that's progress.
That's such a good point. It's about taking those little steps and building momentum over time.
Exactly. And don't forget to jot down your goals. Whether it's finding properties, connecting with other investors, or simply learning more, writing it down helps keep you accountable.
Yes, and as you hit those small milestones, it can really boost your confidence.
100%. And remember, the real estate journey is a marathon, not a sprint.
So true. With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
So as we wrap up this episode, let's quickly recap some of the key takeaways about opportunity zones.
Absolutely. First off, the tax benefits. They can be a game changer for investors. The ability to defer and potentially reduce capital gains taxes is huge.
Right? And then there's the importance of the long-term perspective. You really want to commit to holding your investment for at least 10 years to maximize those tax advantages.
And let's not forget the community impact. Investing in these zones can really help revitalize neighborhoods, creating a win-win situation.
Exactly, Sarah. It's not just about building wealth for yourself, but also contributing to the growth of the community.
And for those over 40, this can be a fantastic opportunity to diversify your portfolio. You know, consider blending traditional investments with these unique options.
Definitely. It's all about making informed choices and taking calculated risks.
So as we think about building wealth through real estate, remember that it's a journey, not a sprint. Each decision can lead to long-term benefits, both financially and personally.
Well said, Sarah. And speaking of long-term benefits, if you found today's discussion helpful, we'd love for you to like this episode and subscribe to the podcast.
Yeah, and don't forget to comment. What was your biggest takeaway? Or do you have any questions about opportunity zones?
And share this with anyone you know who might be over 40 and interested in investing in property. It's never too late to start building wealth.
Exactly. And next time, we'll dive into something super exciting, cost segregation studies. We'll share some accelerated depreciation tips that can really help boost your cash flow.
That's going to be a great episode, so be sure to tune in.
Thanks for joining us today.
Take care, everyone.
Bye for now.